Welcome back, variants. Today we're going to talk about VV and taxes. But before that, the Black Panther collectible just dropped. Let us know how you did in the comments section after we talk about these taxes. So how did you do on the drop?
Again, big L. Big L. I tried both phones.
Well, lucky for me, your boy got a sub 1000 ultra rare on the drop.
No way.
Yep, I sure
Really?
did. And on top of that, as people were undercutting themselves, I managed to scoop up an uncommon for 8 gems over the mint cost. So 58 for an uncommon. Pretty sweet deal.
That's I'm happy for you.
Well, this is a team effort, so it's all good.
Yeah, awesome. No, that's awesome. I mean, that's crazy. I have not got a drop in like 6 weeks. Like at least 6 weeks. So I'm really hoping they start doing the weight room. I think that's gonna help a lot for us non-fast fingers.
You gotta work on that your click action. All right, so let's get to talking about the taxes.
So, if you guys don't know, there's a lot of misconception in the NFT market, crypto space, and to simplify it, a lot of people are under the assumption that when you sell a cryptocurrency or an NFT, and if you take that money and put the profit into another crypto or NFT, that it is not a taxable event, the previous sale. I'm sorry to tell you, it is a taxable event. Every time you sell cryptocurrency, every time you sell an NFT, you have to put the transaction on your tax return. So you have to put when you bought that item, how much you bought it for, when you sold it, how much you sold it for. It can get very tricky with cryptocurrency, especially if you bought, let's just say, 5 million OMI, and then you sold 1 million of it at a profit. Now that makes things not extremely difficult because you bought all 5 million at one shot, and then when you put on your tax return, you put that purchase date, and you're gonna put the sale date. But if you're going in and you're doing $100 at a time, and you do 1,000 transactions in a year, you're really gonna need to get like a coin tracker, something that's gonna document all these, because every single buy and sell has to be documented. And back to now with the NFTs, if you're buying these NFTs and you're buying one for $7 at the drop and then selling it at the market, that's called a short-term capital gain. You sold it within a year. That's a 35% tax. Good news, because VV they're calling it in-app gameplay, currently it's not considered a taxable event because it's considered a game. But once you're able to extract the money and you're getting some type of fiat currency or even a cryptocurrency, if you trade it from VV to OMI, once you make that transition out of app, it is gonna be a taxable event. So be very careful.
It's kind of why we don't want MTL right now, because we don't want to do all that accounting stuff with how much the gems are worth or how much the NFTs are worth right now. Later on, when MTL does come live, then you got to keep track of all that stuff.
MTL is in the sense of taxation. MTL can come sooner than later. What really needs to come first, though, is the actual accounting within the VV app. Because if you go into the VV app and you go to the transaction history, you go to your wallet, you go to transaction history, and you pull up a transaction, and what you'll see here is that when you go into the transaction, you're gonna see that you sold Superman, or not, Superman's not the best example, a Spider-Man. It doesn't usually tell you what a rarity is it. Is it a common or is it a secret rare? So you don't have that information. You can't even, it's very hard for you to go back to see even what NFT you sold. So in addition to that, it doesn't tell you your actual basis, meaning it doesn't tell you what you bought it for. So your accounting has to be extremely good. And I ran through a mock-up of like what would it take me to do it if I was going to do it perfectly. And the reality is I would have to document every single purchase on an Excel spreadsheet. And then as I bought it, and then as I sold it, I would also have to document that on an Excel spreadsheet and try to find it exactly where on the sheet that I have that same exact item. That is very, very tedious. So I'm hoping that they can use the blockchain that they've set up, because they have these smart contract codes on these NFTs where they make it accessible for us to see them, so then we can draw from that number to the sale, and it should be very easy to account. Because once we get the bookkeeping down, the tax part becomes a little bit easier. It's the bookkeeping is the tedious part. Now that we've mentioned that, the next thing that we would want to talk about is keeping in mind that if you are a hodler, you benefit in the tax code. If you're holding over 1 year, 365 days, you're considered a long-term capital gain, and you get the 15 to 20% tax bracket. If you're short-term, you're roughly 35%. Being a long-term hodler benefits you. But again, there's people out there that love to trade and flip, and you know what? They help us, especially when they sell their NFTs below the floor price. Well,
this is not financial advice, because what you have, the laws in your country could be different from what our laws are. So make sure you consult a tax professional in your own specific location.
Yeah, and I'm speaking generally of countries have very similar, like I'm speaking specifically about the United States. I'm a tax preparer in the United States. This information is generally how it is applied. You individually, the application could be different. But most developed countries have a very similar tax code.
Right.
So
some people have higher taxes than others in certain countries.
Yeah.
Also, I don't know if it applies to whatever country you're at, but I don't know if in the United States, having a collectible is taxed different, and maybe an NFT that's a collectible could be taxed differently.
So with that, you bring up a good point. So here, let's talk about this actually, for example. So this is a comic book. Everyone knows what I hope you know what a comic book is. So this is a collectible, but it's also considered artwork. So I actually knew an accountant, and I learned from a lot of the best people out there that what people do is when they buy collectibles, they will buy a collectible, put it up on the wall as art, and when you list it as art, you can list it as an asset. Now, for your business, if your business is purchasing this art, you can list it as an asset on your business. In the tax code, you're allowed to depreciate your assets. So he would buy a bunch of collectibles, and as he's making more money in his business, he would depreciate the cost of his collectibles on his taxes. So let's just say he made, $500,000. He would buy like $200,000 worth of collectibles, put them up all around his office, and he would then write that down off of his taxes on the collectibles. So it's a way to treat collectibles. Now again, so there's multiple ways you can actually buy collectibles through your retirement account, but that strategy isn't officially buying through your retirement account, but it's going to function very similar, because as you depreciate the asset, write down your income, you have less tax owed. It's similar to putting money into like a 401k or retirement account. Then later though, when you sell your business or you sell your asset, you're going to then have to claim the income on it. But again, if you hold it for longer than a year, it'd be a long-term capital gain. One little asterisk I want to give you is that if you do this, and you have a useful life on that collectible or art piece, and let's just say you make it a year. If you sell it below a year, you would have recapture, which you want to avoid that. Speak to your tax professional to say how this could affect you in the best strategy for your particular situation.